G'day fools, Scott Phillips here, the Motley Fools Chief Investment Officer here in Australia. By now, if you've seen a few of my videos at times like these, you're probably having a Pavlovian response because I tend to do these when the market is either down or going to be down. And as I record this on 8:30 a.m. On Wednesday morning, September 14, I think it is. Let me double check that. It is September 14. You are about to find out, if you haven't already, that the US market fell by 4.3% overnight. That was the S&P 500. Every single stock on the NASDAQ 100 closed down for the first time since March 2020. And that fall for the S&P was the worst result in the US in 2 years. Worst drop in 2 years. Now, that really means the Australian market is almost certain to fall, and the ASX 200 futures have us down about 2.5%, give or take. That will change as the morning goes on. That will change when the market opens. It may well have changed by the time you see this video if you're not going to see it relatively quickly after I've recorded it. Let's go back to the US for a second, then we'll come back to Australia. I want to ask you to think about your perception of what happens on markets and also how the markets are talked about. Now, the headline says, biggest fall in 2 years. The other alternative headline would have been, wow, this only happens once every 2 years. That's pretty good. And I think it is. So I want you to keep that perspective in your head, right? Which narrative are you going to listen to? Which narrative are you going to tell yourself as we go through today on the market, as we go through the next days and weeks and months and years? Because the narrative is important. The worst day in 2 years, big deal, right? That must mean a big drop by definition. There have been other drops over that period of time. This is the worst one. It's a big deal. As I said, on the flip side, it happens once every 2 years. That's a pretty good result as far as I'm concerned. So let's keep that in mind. Next thing I want to talk to you about is the ASX here. We are going to follow the US. Why? Well, we tend to slavishly follow them anyway, but this time around, the issue in the US was, guess what? Yep, inflation. They had overnight a higher inflation read than the market was expecting. It was down, this is the month of August, it was down on the July number, so that's a positive, but it was higher than the market expected, and they put two and two together and said, hey, that means the US Federal Reserve, their version of our Reserve Bank, is likely to increase rates more than they otherwise might have, or simply aren't going to be as dovish, or they're not going to as quickly stop raising and then start lowering as the market might have thought. Mathematically, there is a little bit of logic there. The higher interest rates are, the less other assets should be worth by definition for two reasons. One, the cost of debt is higher. Two, more importantly, the cost of what is seen as the risk-free asset, in other words, US Treasury bonds, is you get a better result from that, right? The interest rate on US Treasuries is higher, therefore other assets are not as attractive relative to what is seen as risk-free investing, which is US Treasuries. Now, nothing is completely risk-free, of course, but the market takes its cue from US Treasury bonds. The higher the rate on those, the lower the price, generally speaking, on other assets. And that makes some sense. Now, one inflation number for 1 month, should that have a 4.3% impact on the market? No, absolutely should not. So there is also a heap of sentiment here. I'll remind you again, the so-called smart money, the so-called professionals, those who sit in their glass offices and make big multi-billion-dollar decisions, they're supposed to be the smart, the educated, the informed, the calm part of the market. 4.3%, $1.25 disappeared because people got a little bit worried about inflation. Again, I'm not saying it's not real. I'm not saying it's not happening. I'm not even saying it's not a big deal. The size of the fall relative to the new news on inflation, massively out of proportion. And that's what's been happening in the market over the last 12 or 18 months. Traders, investors aren't used to inflation. I posted on Twitter this morning a link to the New York Times article. You can jump on my Twitter accounts, at TMFScottP if you want. And you see the inflation numbers in the US are the highest they've been since the early 80s, right? 40 years, that's 2 generations, it's most people's working lifetimes. A 60-year-old today only might just remember that in their working life. If you're 55, you haven't seen it in your working life. You're 15, maybe even younger, because it's kind of early 1980s, right? Last time we had this sort of inflation. So the good news is the central bankers know, understand, have studied the history, and they're going to do the right thing. The bad news is for the rest of us, and I'll say them, I won't call myself part of the us, the rest of them are going to overreact from time to time to these inflation numbers. Again, I'm not saying they're not serious. I'm not saying they're not a big deal. They absolutely are. Let's go back to the 1980s, actually, because that's relevant, right? The US Fed put the US economy into recession to kill inflation off. So it's possible they'll do that again. In fact, it's possible the US is already in a recession. It's possible Australia goes into a recession. I'm sorry to say that out loud. It's possible. Frankly, the worse the US is, the more likely it is that we do because of this globally interconnected world. So that was a big deal in the early 1980s. You're sitting here thinking, what the heck? I don't want that. That sounds terrible. I better sell everything. Here's the story. The 1980s were an almost unparalleled decade of massive value creation for business and for assets, for shares. So before you do the 1 + 1 = 2 and say high inflation means lower share prices, therefore I should sell everything, I want to remind you of what came next in the 80s. Now, it's no promise, no guarantee. History doesn't repeat, but it does potentially tend to rhyme, as Mark Twain said. So just keep that in mind as well. Second thing I want to talk to you about is a parallel with the COVID crash. Remember that we had a massive market fall in February, March of 2020, 2.5 years ago now. Wow, time flies. Over that period, since that period of time, by the way, as COVID got worse, frankly, the big hit was, oh my goodness, this could be huge. And it was. The market then recovered. Fastest bear market in history. The market here fell 38% in 1 month and 4 days. Probably 22 trading days, something like that on average. Massive fall. Massive fall. Also then the fastest recovery in history. And the market then went higher and higher and higher and higher as case numbers climbed, as Delta turned up, as Omicron turned up. And so that's the other part of this story. Don't make the mistake of doing a one-for-one translation or correlation between the environment and share prices. Now again, I don't know what will happen this time. No one does. That's the other thing, right? I'm going to be the guy who says, I don't know what happens next. Everyone else will pretend they know and make predictions. I don't know what happens next. But don't forget that often the market and the broader, I'll say economy or society in the case of COVID, is simply not very well correlated. Don't assume just as COVID gets worse, the market will fall. So much money was lost by so many people who said, I'll wait to invest until COVID's over. Well, guess what? We're 2.5 years into the pandemic. It's largely becoming endemic, but COVID's not over. And yet the growth in share prices between particularly the bottom of that crash, but even before the crash started, we're still ahead of those numbers, at least we were until yesterday. I think we still are, but I'd have to double check that. The key message here is the market recovered in the 80s after a recession and when everyone thought it was going to be a terrible outcome. The market recovered during COVID, during the worst of COVID, the market recovered because investors, traders saw common sense. They realized that their early panic wasn't necessarily going to translate into long-term value destruction. Isn't that likely this time around too? I think it is. No guarantees. I'm not going to give you a guarantee. I'm not allowed to, and nor would I. No guarantees. But isn't it likely? I'm pretty sure it is. Yeah, I think it actually is. So keep that in mind as well. Here's my last thing I want to leave you with. It's one I've talked about before, and I will probably say again and again and again. Here's my line. The ASX, the stock market, the US markets, by the way, are the same. The ASX has never yet failed to regain and then surpass a previous high. So when it goes down, it's always gone back up to the high point and then it's gone higher again. Again, maybe it's not the case this time, but unless we've seen the very best of democratic capitalism, unless we look back on 2021 and say, gee, that was the pinnacle of human achievement, wasn't it? Unless capitalism has absolutely already peaked permanently, then we will get back to that. It's literally mathematically true. Unless it's peaked, and it might have, but unless it's peaked, we will get back to and then surpass that because we go to a new peak over time. Now, so that's the first thing. Second thing is, the further we are from that peak on the way down, the more it's going to go back up to get to the peak and then go higher again. In other words, the gains available when the market is below its previous highs are significant and probably very large. And so think about that. Think about the long-term value creation of investing, of shares, of public companies, of businesses that go out there and find new solutions to old or new problems. It's what they do. That's what they'll continue to do, and it's why I think it's a smart bet to bet on democratic capitalism. Now, that's where we find ourselves. Right now, people are worried about inflation and rates and everything else. The market is going to fall today. It fell in the US overnight. We have a choice. We can either run like the lemmings, from side to side on the ship, trusting those so-called smart money and professional traders and investors who are supposed to know these things. Good luck with that. Or we can put our confidence in not only the arc of history, not only the fact, as I said before, the market's always regained, then surpassed a previous high, but even putting that aside, our confidence in the men and women out there who are trying to find new solutions to new and old problems, find better ways of making more money for their shareholders. I think that's a really smart bet. I think it was Paul Keating, quoting New South Wales Premier Jack Lang, who said, always bet on self-interest. At least you know it's trying. So if you want to be entirely cynical about it, think about the shareholders, think about the owners and managers, the founders, significant shareholders who've got all their money tied up in some of these businesses, and ask yourself, are they going to try desperately to create more value? Yeah, I think they are. So be as cynical or as altruistic as you like in any of those cases, whether you want to bet on human ingenuity, the arc of human progress, or whether you want to bet straight on self-interest. Feel free. I don't mind which one of those you take, but I reckon they're going in exactly the same direction. So here's the thing. I'm going to buy some shares. I'm not going to buy shares because this is the bottom. I'm not going to buy shares because it was a massive dip. I'm not going to buy shares for any other reason than it's what I do. It's what I do. I try and do it month in, month out most of the time because I believe in the power of dollar cost averaging. I believe in the power of democratic capitalism. I'm here for the ride. I'm going to leave you with one last stat. This is one you've heard from me before. By the way, if these videos sound familiar, fantastic. Because if they sound familiar, then it means the messages are getting through. And I don't even apologize for that. I'm sorry if it's a bit boring. But if you're like, I know what he's going to say, great. Great, because it means you've internalized it. I hope you do. I hope you can do this by rote. I hope we don't have too many more of these, but I hope you can do this by rote over time. So, I believe, as I said, in all of those things. And I believe in the power of dollar cost averaging because it lets us put our money to work regularly. And here's the thing. If the market goes up over time, on average, the earlier you have your money in the market, the better the statistical odds of you making money. Almost by definition, because the market's going to go up over time. If it keeps going up, then statistically likely to be higher in the future than it is today. Not guaranteed, not even necessarily overwhelmingly likely every single time, but more often than not. And here's the thing. You toss a coin, you got a 50-50 chance. If you got a 60-40 loaded coin, you should toss that coin as many times as you possibly can. Why? Because even when you lose 40% of the time, as long as you're getting a 2-for-1 return on your wins, you're going to come out miles and miles ahead. You should want to toss that coin as many times as the poor sucker will let you if it's a loaded coin. Now, I think the market is a loaded coin. I think shares will continue to rise over time, over the long term, not every day, every week, or even every month, or even every year. We'll have bad years. We'll have terrible years. I'll be investing during those times too. Now, maybe you're not adding money to the market. If that's not you, that's cool. At least stay the course because, again, if shares go up over time, and they tend to, statistically, the longer you stay in the market, not even adding money, if you stay in the market, you're likely to make more money. And again, that is the fundamental reality of the investing story thus far, and I have a very high conviction it'll remain the story of investing from here moving forward. The last number I promised you, Vanguard. You know I love the Vanguard index chart. I've told you about it a trillion times. The Vanguard index chart suggests over the last 30 years, to June 30, 2022, 10 grand invested 30 years ago, now was worth on June 30, $130-something thousand. That's a 13-fold return in 30 years for doing literally nothing. Now, I told you about democratic capitalism. I told you about the arc of progress. I told you about self-interest. If those are all woolly terms and you're a numbers person, cool. 10 grand, 130 grand off the top of the screen, right? Miles higher. Just by leaving your money invested. You didn't have to add any money. If you'd added money, by the way, it would have been even better. That's an astonishing result. Would have been, do the numbers yourself. Even if you didn't add a single dollar, you put 10 grand in, or $10, or 10 cents, or $10 million if you're lucky enough. The 13-fold return, the statistical mathematical return, was a 13-fold gain from a 30-year investment. That's all you had to do was leave it alone. You specifically had to leave it alone. During all of the crashes, all of the geopolitical events, all the macroeconomic events, all of the currency events, all of the fear, all the headlines, all the everythings. During, by the way, the GFC and the COVID crash, you just had to leave it alone. And 10 grand became $130,000. Now, I think that is a compelling, an overwhelmingly compelling reason to continue to invest more, to reinvest your dividends, to put the power of democratic capitalism in your favor. That's what I'm doing, as I said. Some people say, oh, you say that you're a shares guy. Yeah, I am. You know why I'm a shares guy? Because I believe in the stuff I just said. This is not me spouting a line. I don't have any investments other than my share portfolio, by the way. This is not me spouting a line. This is not me defending my turf or somehow arguing my patch, right? I don't, if property is a better place to invest, go for it. I don't care. What I think is shares are a fantastic place to invest, have been over time, fantastic tax advantages, capital growth opportunities, just an amazing place to invest. That's why I got into shares, because I believe in it in the first place, right? I don't do this because I'm a shares guy. I'm a shares guy because I believe in the story that I've just told you. So that's it. I've spoken long enough. Today will be tough for some. Your portfolio, like mine, will be full of red. It might be even largely red. I expect I'm going to have a terrible day on the market. If I'm a betting man, I've got some growth companies in my portfolio. They will be worse than the average market. So if the market's off 2.5%, I might be down 3 or 3.5%, maybe even 4%. That's a lot of money, right? But that's just the volatility that you have to put up with as the market does its thing. As I said, me, staying invested, adding more money to the portfolio. I might even buy some today, haven't decided yet. Probably will, just because I've got some cash in the portfolio. It's about time I put it to work. I tend to spend so much time talking about stocks that I block myself from actually buying any. The trading rules of the multi-fill preclude me from buying something I've talked about in the next 2 days or 2 days prior. So I'm kind of locked out for a week every time I mention a company. So I should probably buy some today. I probably will. I think most of our readers, viewers, members, in this case viewers, should be very seriously considering doing the same, as long as it suits your financial circumstances. All right, that's it. That's me. I hope today isn't too rough. I hope you will stay the course. I hope you will go to Vanguard Index Chart on Google, print it out, stick it next to the computer, stick it on your desk, stick it in the hallway. My nephews have it above their stairwell. It's my idea. Pretty pleased they did that. That is your touchstone for today. It's your touchstone for tough markets, because the long-term outcome, I expect, will be very, very similar to what the long-term historical outcome has been, and that makes investing incredibly worthwhile. Until next time, Fuller.